All right, traders, welcome to Behringer Train. So let's look at gold, and this is a very difficult chart and trade to consider, but it's one that we should discuss. So on Friday, we had Friday night, we saw a huge rally, which was met by supply, created this upper wick here, which we all know is selling, and created a lot of supply. So we had a big rejection of the 200-day moving average, which also was a rejection of this upper trend line that creates this bearish descending channel. So the overall trend here is bearish. We did see a strong rally, but really prices just became oversold relative to that rally. If we look at the negative delta, we see some participation off lows here, but since then there's been nothing but selling pressure. So that's obviously very weak. What I also want to point out is that we rallied up on 3.7 million contracts and then 1.7 and then 1.4. So we can appreciate there's shortening of the up thrust that's present. That's bearish. And we can objectively appreciate that there's less and less participation on each of those. Now, we did see a breakdown, but on this breakdown, we found support along the lower trend line, which just continues to validate the trend, the bearish descending channel. But what I want to point out is that if the conditions were bearish, if this was a bearish trade, this supply would have made a new low. In other words, it would have traded below this preliminary supply that's present, and it didn't. So it's kind of, that is bullish. And then we rally away, but now we rally away on 3.29 million contracts. So that's a lot of contracts. Why didn't all these contracts, result in new highs? Well, because there's selling that's present. There's liquidation. These guys are trapped, so they're selling. There's new shorts. People are shorting the 200-day moving average. They're shorting this upper trend line. And you can appreciate that through the delta that's here. So I am a little biased that we're seeing some distribution. Given the amount of time that we spent in consolidation, that would give us a $20 to $30 price move. But how do we trade this? Let's look at the hourly chart. If we look at an hourly chart, we can appreciate support here, right? We can also appreciate, these up waves. So we have 223,000 contracts, 181, 107,000 contracts. There's less and less participation, but yet we've yet to encounter supply. So we have 123 on the downside, 197,000 on the downside, and then here we are. So we had 107 up here, 294 here, and prices didn't really break out to strong highs. So there's some distribution present. And what do we have? We have a breakdown. We have 240,000 contracts on the downside, but supply was really unable to overcome demand because we found support along this lower trend line. So now we rally away on the least amount of participation yet, 66,000 contracts. I think we're seeing a change in character that's here. So, if I add to the characteristics or, the observations on the daily chart, and then now we have this climax and this huge dump here, and we have the emergence of supply. What bears need, short-term bears need, is for prices to break down below this lower trend line and then test it with weak participation with no buyers. And somewhere around here is where you want to short with no participation, and then play that trade into that $20 or $30 price drop that's there. Now, given that the selling last time didn't exceed here, I believe that again we'll find support along this new developing lower trend line that's here. So for seeing distribution, I would you want to take your short on confirmation, so a breakdown, sell buy the weakness that's there, sell the weakness that's there, and then take profits as we approach this lower trend line. We'll see. We'll keep talking about it. Good luck.